Welcome to Section 4 of the ASC 718 SBC training series. We have covered the full life cycle of a standard award: classification, measurement, vesting, and expense recognition. Now we handle the complicating events. What happens when you change the terms of an existing award? How SBC creates dilution that must be reflected in earnings per share, and how SBC interacts with income tax accounting. These three topics, modifications, EPS, and tax, are where SBC accounting gets complex in real engagements. By the end of this section, you will be able to apply the incremental value model to calculate the additional compensation cost triggered by an award modification. You will understand when a cancellation and replacement is treated as a modification versus a new grant. You will be able to step through the treasury stock method to calculate the dilutive effect of in-the-money options on diluted EPS. You will understand how book SBC expense creates a deferred tax asset, and how that asset resolves when awards vest or are exercised. And you will know when excess tax benefits and shortfalls flow entirely through income tax expense under a SU 2016-09. A modification is any change in the terms or conditions of an existing SBC award. The definition is deliberately broad. Repricing an option by lowering the exercise price is a modification. Extending the vesting period is a modification. Making a performance target easier to achieve is a modification. Even accelerating vesting upon termination, which companies do regularly in severance negotiations, is a modification. The modification date becomes the new measurement date. Both the original award and the modified award are measured at fair value on that date, and the difference is the incremental value that drives additional expense. The formula is clean, but the application requires care. Incremental value equals the fair value of the modified award minus the fair value of the original award, both measured on the modification date. Notice that you measure both sides at the modification date, not at the original grant date. Even if the original option is deeply out of the money and its fair value is close to zero, you still run the model. The incremental value is then recognized as additional compensation expense over the shorter of the remaining vesting period of the original award or the vesting period of the modified award. Critically, the original grant date expense continues on its original schedule. Modification expense is layered on top. The company ends up recognizing at least the original grant date fair value in full, plus any positive incremental value from the modification. Repricing is the most common and most analyzed modification. A company whose stock has fallen below the exercise price of outstanding options often wants to reprice to restore the incentive value. The incremental value is the difference between the fair value of the lower strike option and the fair value of the higher strike option on the repricing date. If the original options were deeply underwater, that original fair value may be small, making the incremental amount large. When a performance target is made easier, say, lowering the revenue hurdle, the result is typically a positive incremental value because more awards are now expected to vest at a higher probability. Termination acceleration is perhaps the most frequent modification in practice. When a senior employee departs and their unvested awards are accelerated as part of a severance package, any unrecognized expense for those awards must be recognized immediately on the modification date. When an existing award is canceled and replaced with a new award, a SC 718 requires analysis of whether the replacement is a modification of the original award or a new grant entirely. The key rule: if cancellation and replacement are simultaneous, treat it as a modification and measure incremental value. If there is a gap between cancellation and replacement, the cancellation is a separate event. For a cancellation with no replacement, the rule is simple but frequently missed. Any unrecognized expense for the canceled award must be recognized immediately. The company already committed to that service. The cost should not disappear just because the specific award form changed. A common error is to continue amortizing the remaining expense over the original would-be vesting period after cancellation. Stop. Cancelled awards require immediate recognition of any unrecognized balance, not continued amortization. Stock options, SARs, and unvested RSUs represent shares that could be outstanding in the future, which dilutes the ownership interest of current shareholders. Diluted earnings per share must reflect this potential dilution. The treasury stock method is the required approach for options and SARs. The logic is intuitive. Assume all in-the-money options are exercised at the beginning of the period. Calculate the proceeds, exercise price times the number of options. Then assume those proceeds are used to repurchase shares in the market at the average market price for the period. The net dilution is the shares issued on exercise minus the shares repurchased with the proceeds. Because the buyback offsets some of the dilution, the net dilutive effect is smaller than the total options outstanding. For RSUs, there are no exercise proceeds, so every unvested RSU share counts as fully dilutive. There is no offset. Let us make this concrete with the numbers from the handbook. A company has 100,000 options outstanding with an exercise price of $20. The average market price for the period is $30. Under the treasury stock method, assume all 100,000 options are exercised, generating proceeds of 100,000 times $20, which is $2 million. Now assume those $2 million in proceeds are used to repurchase shares at the average price of $30. That buys back 66,667 shares. The net dilutive effect is 100,000 shares issued minus 66,667 repurchased. A net addition of 33,333 shares to the diluted EPS denominator. The intuition is that the higher the exercise price relative to the market price, the more shares can be repurchased, and the smaller the dilutive effect. Options that are out of the money, exercise price above the current stock price, are antidilutive and excluded from diluted EPS entirely. Before a SU 2018-07, accounting for SBC awards granted to consultants and other non-employees was significantly more complex than for employee awards. Non-employee awards were measured at the later of the grant date or the vesting date, which created ongoing remeasurement and volatility right up until vesting. A SU 2018-07 substantially aligned non-employee SBC with employee SBC now. Non-employee awards are measured at the grant date using the same option pricing models. An expense is recognized over the service period, the same framework as for employees. Some narrow differences remain for specific non-employee award features, but for the vast majority of grants to consultants or advisors, the accounting is now the same as for employee awards. SBC creates an important timing difference for income tax purposes. The company recognizes book SBC expense over the vesting period, but the actual tax deduction is only available when the award vests or is exercised, and the deduction is based on the fair market value at that later date, not the original grant date fair value. This timing difference creates a deferred tax asset over the vesting period. The DTA equals the cumulative SBC expense recognized so far multiplied by the statutory tax rate. When the award vests or is exercised, the DTA reverses as the actual tax deduction is taken. Here is where it gets interesting. If the stock price at vest is higher than the original grant date fair value, the tax deduction exceeds the cumulative book expense. That excess is an excess tax benefit. If the stock price has fallen, the tax deduction is less than the book expense. That is a tax shortfall. Under a SU 2016-09, both excess benefits and shortfalls flow entirely through income tax expense in the period of vest or exercise. The excess tax benefit and shortfall mechanics affect the effective tax rate in the period awards vest or are exercised. In a period when many awards vest at a stock price higher than the original grant date fair value, common in bull markets, The company will report excess tax benefits that meaningfully reduce its effective tax rate. Analysts and investors watch this line closely because it can make the effective tax rate appear lower than the underlying business rate. Conversely, when awards vest at a price below the grant date fair value, the shortfall increases income tax expense, pushing the effective tax rate above the underlying rate. Both effects are now reported in operating activities on the cash flow statement under a SU 2016-09. Previously, these were reported in financing activities. Modifications, EPS, and tax represent three distinct technical areas that each require careful attention in practice. Modifications require measuring incremental fair value on the modification date, whether the change is a repricing, a target adjustment, or an acceleration upon termination. Cancellation and simultaneous replacement is a modification. Cancellation alone triggers immediate recognition of unrecognized expense. Diluted EPS requires the treasury stock method for in-the-money options, with the net dilutive share count added to the denominator. Tax accounting creates a deferred tax asset over the vesting period that resolves when awards vest, with excess benefits and shortfalls flowing through income tax expense under a SU 2016-09. In Section 5, we bring everything together through journal entries, worked examples, financial statement presentation, required disclosures, and the U.S. GAAP versus IFRS comparison. Thank you for completing this section on modifications, EPS, and tax. Thank you for watching. Subscribe for more training from PNJ Group.